Disclaimer: the following report is a detailed analysis of a hypothetical scenario and does not reflect real-time events. It is intended for informational and analytical purposes only. Good evening. You're watching Crisis Clips. In a startling hypothetical development, U.S. military jets have reportedly crashed in Kuwait amid escalating tensions in the Middle East. Meanwhile, Iran has publicly stated that no talks with former President Trump are planned at this time. The world is holding its breath as uncertainty ripples across international markets and geopolitical spheres. In this scenario, the Gulf region, a strategic hub for global energy, faces heightened volatility. Kuwaiti airspace, typically a corridor for commercial and military operations, is suddenly the center of intense scrutiny. The U.S. military confirms losses but has not elaborated on the extent, prompting analysts to assess possible implications for regional stability. Iran, in turn, remains firm on its position, emphasizing that diplomatic engagement with former U.S. leadership is off the table, signaling a continued hardline stance. To understand the gravity, consider the geopolitical backdrop. The Gulf is home to nearly a fifth of the world's oil exports. Any disruption, even temporary, can trigger cascading effects. Crude prices could spike, shipping insurance premiums may soar, and global supply chains could face unprecedented strain. Stock markets from New York to Tokyo respond not just to the military incident itself, but to the potential economic shockwaves it generates. Oil futures, energy sector equities, and defense contractors' shares are all particularly sensitive in the first hours of such crises. Now, let's examine a what-if scenario over the next 48 hours. If tensions escalate, additional U.S. military deployments may be ordered. Iran could respond with strategic measures affecting shipping lanes in the Strait of Hormuz. Global oil shipments could slow, triggering immediate spikes at gas stations worldwide. Hedge funds and institutional investors would react swiftly, moving capital into safe haven assets like gold and U.S. treasuries. In this hypothetical escalation, the ripple effect touches airlines, shipping companies, and commodity traders, creating short-term turbulence in global trade networks. Economically, the consequences could be profound. Oil prices, already sensitive to supply disruptions, could surge by 10 to 15% within days. For the U.S., this translates to higher gasoline and diesel costs, directly impacting consumer budgets. Stock market volatility could see the S&P 500 and Dow Jones swing sharply, while energy and defense sectors may experience significant gains. Inflationary pressures would intensify, potentially prompting policy deliberations at the Federal Reserve regarding interest rates. Defense spending could rise as contingency plans and regional deployments are activated, influencing the federal budget and long-term fiscal planning. The impact on everyday Americans would be immediate. A typical family filling up a tank of gas could see costs rise by several dollars overnight. Transportation and shipping costs for goods would increase, influencing the price of groceries, household supplies, and energy bills. Small businesses reliant on imported components might face disruptions, further stressing local economies, even for households not directly involved in energy consumption. The psychological impact of economic uncertainty can affect spending behavior, savings, and retirement planning. Amid these macroeconomic forces, human stories emerge. Imagine a small logistics company in Houston, Texas. The owner, Maria, relies on timely deliveries of raw materials for her manufacturing plant. Overnight, shipping routes are delayed due to precautionary measures, diesel prices spike, and operational costs climb. For Maria and her employees, this is not just a numbers game, it's personal, affecting paychecks, production schedules, and long-term sustainability. Her story reflects the very real intersection of global events and individual livelihoods. Experts weigh in with cautionary analysis. International relations scholars emphasize that the Gulf remains a flashpoint, where miscalculations could escalate rapidly. Energy economists highlight that even brief interruptions in oil supply can have lasting effects on global markets. Financial strategists suggest that investors diversify holdings, maintain liquidity, and monitor risk exposure in energy-dependent sectors. Defense analysts note that regional military maneuvers, while precautionary, carry inherent risk of unintended consequences. For viewers of crisis clips, the takeaway is clear. Geopolitical crises, even hypothetical, are not abstract. They shape the economy, markets, and daily life. The interconnectedness of global trade means that events thousands of miles away can reverberate through local communities, influencing the cost of living, job stability, and national policy priorities. As we close this analysis, consider the questions that remain unanswered. How will the global economy adapt if regional tensions persist? Can markets absorb shocks without tipping into recession? And for the average American, how can households best prepare for volatility that starts in distant skies but lands at the gas pump, grocery store, and paycheck? Crisis Clips will continue to monitor, analyze, and break down the complex realities behind headlines, bringing clarity in uncertain times.